Well, here we're going to have a conversation between Antony John and myself, Sarah Quinlan, talking a little bit about the developments in the fund industry as we're seeing it, and also how that impacts both active management as well as passive management, and as well as asset allocation going forward here. Tell me a little bit about what you're seeing in the development in your business going forward.
Well, I think first and foremost there are a number of developments. Firstly, we're seeing the sort of new juxtaposition of active versus passive. We can no longer ignore the role of passive management in a sense, a separation of alpha and beta. Moreover, at a basic research level, we are beginning to see the need for much more extensive operational due diligence, which in itself involves a lot more resource and a lot more questioning of individuals before making a decision. And significantly, some of those decisions are overriding basic investment decisions, which is probably a first. It's a major change.
But interestingly enough, does that lead to shorter term behavior in terms of investors?
No, I don't think it does. I think what it does, it means that you get a much deeper appreciation of the firm or the manager that you're investing in, with the view to building a longer term relationship. I think one of the things that we've all learned through this crisis is that we all need to be much longer term in outlook and build deeper, more strategic relationships.
Well, it is interesting because I actually think you'll get better assessment of a client's actual risk return parameters and are able to really deal with the proper asset allocation, which obviously will help lead your product development as well as the sales process.
Well, I think that's absolutely right, Sarah. I think one of the key things that goes along with that is exactly that, is much more diversification and much more emphasis on asset allocation strategies within portfolio management, encompassing a far broader range of assets.
But don't you think that also will lead to actually less involvement of the individual in their investment decisions and more institutional level decisions, as opposed to leading it down to the individual due to the regulatory issues?
I think that's an interesting one. I think this is yet to be sorted. Clearly, if we look at very developed markets like the US, the consumers themselves have a high sort of self-interest in terms of what they invest in, self-selection through the various platforms, and wrap platforms in particular. However, what we're seeing is to some extent the professionalisation of that process, with the need for broader research. And if anything, I think it will lead, the recent shocks have led consumers to understand that you can't be a part-time investment manager. It's a full-time specialist occupation.
So true. And the most interesting thing about that actually is, of course, the retail investor was hurt the most in the crisis of 2008 because they actually were forced to sell or chose to sell as opposed to holding and getting the rebound that occurred in 2009, whereas many institutional investors actually did not change their allocation or investment choices at that point, which led to them actually benefiting from the recovery. So it's an interesting dynamic because the companies in the U.S. have, of course, passed off the responsibility to the individual, and I wonder if the regulatory authorities in the U.S. will continue to permit that, and the other countries which were following suit will actually continue to go down that path.
I think you'll see it come full circle. I think what regulators want is they want a clear separation of responsibilities. They want, on the one hand, consumers to be properly protected. I mean, after all, what we've seen in the last decade is the effective global privatisation of savings and pension. Governments can't afford to fund these things, so we need consumers to participate, but we need them to participate in the right way with the right knowledge.
Well, it is always that education conundrum that one faces because obviously, your basic farmer, who we're just talking about China and India in our session there, really hasn't obviously going to have the financial education to deal with his increasing wealth. And it's going to be one of the things that I think will be most interesting going forward. What about commodities? Talk to me about how you feel that that's going to be impactful within your fund development going forward.
Well, I think inevitably we cannot ignore some of these global trends that are emerging, but the key question again is, how do you best access them? And I think here there are still many schools of thought. A lot of investors in developed economies would say, well, I can access this through my main market, through some of the companies that I know well and good. Others will say, well, I can't, let's access it through a collective. Right. Others will be more confident and say, well, let's access it more directly. But I think there you have geopolitical issues, and of course you've got the rise of ETFs on so again, this diversity means that the choice that investors have means that they need a lot more guidance.
Right, education is clearly going to be the key. Although I think the interesting thing is, I think also that developed economies will figure out how to profit from what's going on in the developing world. And I think that they will find a way to participate profitably so that you'll be able to invest across both classes, which I think will be an interesting way, and frankly a more liquid way, because we do realize still that there's a liquidity issue in the emerging markets versus the developed markets.
I think that's absolutely right, but I think again what we will typically see, and hopefully actually, is we'll see a generational step, just as we have done in telephony, from sort of landline based telephony straight to sort of 3G and now 4G in developing economies, and I think there's the potential for that step change too in investment.
Thank you very much.
Thank you.
Appreciate it.